It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
When you retire, should your investment strategy stay the same as it was during your career, or is it necessary to make adjustments? The way down the mountain is different and considerably more challenging than the way up. So we're evaluating different retirement investment strategies, that and more, on this episode of The Wise Money Show.
I think if you asked folks on the street, Jay Leno style, hey, what's more difficult, investing while you're saving up during your career or investing during retirement as you're in withdrawal? My guess is people would say it's more difficult on the way up. But we've seen more difficult on the way down. And we're going to help you evaluate different investment strategies so that you can pick the right one for you. If you have a question for the program, we'd love to hear from you. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. Engage with us that way. Leave questions there as well. And then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. Kevin, before on the show, you said that your investment allocation, how you choose to invest your portfolio, is the biggest financial decision each of us make in our life. Why?
Because the one thing that an investor has, or someone who has long-term goals, the driver of those results are going to be exposure to assets and different types of assets. And if you get that right early in your career and you set it and forget it, or you leave it the way it's supposed to be, then your results will be amazing. And if you don't, or if you start late, it's not impossible. It's just harder. It's the degree of difficulty. Because, Mike, you were talking about preparing for retirement or climbing up the mountain.
Yep.
And it's hard climbing down the mountain. It's almost like you wouldn't compare those two. Because climbing up the mountain, if you were looking at 100% of the difficulty is resource allocation and prioritization. So I've got unlimited things that I could spend money on, especially if I have children. And as I'm married and getting to know my wife, and she's getting to know me, and we have to figure things out. And can we, if I have my priorities and she has her priorities, can we have our priorities? So that is its own kind of a challenge.
All of that on the way up the mountain.
Right.
Yep.
There is, on the way up the mountain, there will be inflection points where the market is not behaving like you thought it would. So if you've saved a little bit in your 401k and you've got $10,000 in your 401k and the market goes down like it did in from November of 2007 to March of 2009, and the market goes down 54%. Well, one of the things that was happening is you were buying all along. So it's not like you saw your 10,000 go down to 4,500. So your balance is likely higher, but that might not seem like a big deal. But if you're closer to retirement and you saw $1 million go to $500,000, that is real money. And so that's where it's
with real consequences.
With real consequences, absolutely. In 2008, my good friend in Valparaiso, who had a men's clothing store, it was one of his best years ever. And I thought, how in the world? Everyone's, there's all kinds of layoffs and the market's terrible. Why is it such a good year? And he said, because there are a lot of guys that thought they were going to retire, that realized they weren't, and they needed, their
wardrobe wasn't going to last.
They thought
the new retirement.
Right. They thought the last refresh of their wardrobe was their last refresh, and it wasn't. They had to do it again in 2008. So they went and refreshed. So it's think on my way there, it's mostly resource allocation / prioritization and habits with a little bit of emotion thrown in. And on the way down the mountain, it's almost all emotion.
I was gonna say that exact same thing without knowing exactly the words that are coming out of your mouth. I would say the same thing.
Man, I want to highlight something there, Kevin, because you're describing using climbing the mountain as a metaphor for building up your retirement readiness, right?
Mm-hmm.
Getting to a portfolio size where you'll have the resources to be able to last the rest of your days when you walk away from a paycheck. And we often talk about how building wealth takes 3 different ingredients, and you hit all of them in your description there. But the first one is you got to have cash. You have to have money or resources to be able to put towards such a huge goal like this. And you were describing there, 2007 to 2009, people who kept on contributing even through such a major catastrophic drop, really. They kept buying all along the way. They kept on trickling cash in. That's part of getting up the mountain. But then also you have to put that cash at risk at some level. Like you have to have it actually invested in assets that give you the ability to grow and to compound over time. And that time is the third ingredient in this climbing the mountain type of a metaphor. If you try to get started too late in the game, you're giving up one of your most powerful ingredients, one of the amplifiers of that cash plus growth opportunity. Giving it time is the key. And that's why it gets so scary when you get to the edge of retirement, because you're realizing, well, I don't have as much time. So the drops, they feel more dramatic, and maybe you make bigger mistakes at that point.
So that's where I want to go, Josh, is on the way down the mountain, how should you invest? It is 100% emotion, Kevin, like you said. I mean, even my father, just to throw him under the bus, was a seasoned investor and very comfortable with the ups and downs of the market. The first volatility he experienced in retirement, once he was retired, totally different. It was a different dad that came out and called me during that spout of volatility. It was a totally different person, a different investor. And it wasn't that he was different. It was just when it occurred in retirement, just feels very different. So how should you invest during retirement? And yes, on the eve of retirement and in retirement, there's a few different schools of thought here. And we have our primary approach, but obviously, there's pros and cons of each of these. I want to go through sort of the 5 main ways that you can invest during retirement to help you find, well, what are some of the benefits of that approach? What are some of the negatives, things to look out for? And then equip you to work with your certified financial planner so that you can make this crucial step with confidence and have a successful and confident retirement. I want to start the first one, and this is in, well, a little bit of order. We're saving the best for last. I'll say that. The first one is one of the biggest mistakes we see people make with their investment planning, and that is when they shift into retirement, no change. Their investment strategy, I had a diversified mix during my career. I don't need to change anything, or maybe didn't even realize I needed to shift anything by the time I get to retirement.
Yeah, it seems like this would be normal, right? For you to get to retirement and think, well, what got me here is the same strategy that's going to get me all the way through retirement. It's what I know. It's what I've had success with. It has worked over the long term, and I keep hearing these guys on the radio say how retirement's going to be a long-term stretch and you need to have a long-term game plan. So why not keep on investing the same way that you always have? And what a lot of people don't realize is that maybe the risk profile that they had before, sometimes it drifts on you. You started out with a moderate level of risk. You had some investments grow like gangbusters, and now all of a sudden the stock portion of your portfolio is just much larger. You actually are more exposed to volatility than ever before, and you don't realize that what you think is the same game plan has drifted on you over time.
Well, I think the risk, going back to my dad example here, and my response to him was explaining the fifth investment strategy that we're going to talk about at later in the program. But if If you think, nope, everything's the same. It's the same game. I was investing this way during my career. Now it's retirement. I'm investing. I'm just going to keep the same approach. The likelihood that when you experience that first drop in the market that you say, nope, okay, I'm off the roller coaster, move me completely into safe investments, the odds of that are significant. And that's the bigger risk, not the volatility. That's the bigger risk because it shortcuts your ability to keep up with inflation and have a sustained retirement. So want to get into more of the pros and cons with that investment approach as well as others. We got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning. Also on podcasts at the same time, but also on a couple local radio stations at the same time as well, which is why the content's structured the way that it is and has commercial breaks, which is what we're in right now. But we've got bonus content that we're going to hit in just a moment. But in addition to this long-form talk show, we've got Next Wise Step videos that air right here on this channel, as well as a lot of shorts as well, all designed to help you take your next wise step in your financial life. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. Leave questions and comments below as well. We appreciate it. All right, guys. Bonus question number 1, not curated. What's one money rule that you used to believe that you no longer do?
Wow.
We're getting deep.
Money rule.
You
that
got 20
used to
seconds.
believe.
I'm just kidding.
Dude. Yeah, that might have to come out in the second segment.
Yeah.
Yeah. Do you have one?
Yeah, I've
you
got two.
obviously got to think about this.
No, I didn't, actually. I pulled these up last night, and I didn't. So
All right,
that's just the first one.
Let's hear one, and I'll tell you if I believe it or not.
Gosh, this is controversial.
Bring it.
Stock bond investing.
Ooh.
Diversify stock
we've heard
bonds.
That is, well,
I've heard you say that the 60-40 mix is dead.
Yeah.
so yeah, it is. So for my thinking on this is evolving, and it's data driven, and so this is the challenge is to figure it out.
The underpinning to that is also used to believe, not sure it's true, is that market volatility is the real risk. I don't think that's true.
Well,
I think erosion of purchasing power is the real risk. And one is in your face, hard to ignore, and creates a lot of dopamine response and chemical response. And the other one, you don't even realize it's there. It's the carbon monoxide gas. It's the slow increase of that temperature on that stove.
it's the piece of farm ground that I'm looking at that's for sale for $400,000 that he bought for $120,000
How long ago?
not that long ago,
Wow.
like 10 years.
Wow.
So here's the thing: does that farm ground cost more?
Or there are just more money, more dollars out there chasing farmland.
Yep.
Right.
And so
the effect of
with
inflation.
that, with the
And
with-
there's multiple variables, so you can't say, well, it's just this one thing. But right, I see the world differently today than 15 years ago or 20 years ago. In that 60-40, bonds will help you manage risk, and that risk is volatility. When I just not convinced that's the real risk. Oh, there's volatility out there and it's scary. So you need to have a plan to manage it. I'm not saying that, that doesn't exist. I mean, that's what this entire topic that we're hitting right now, that's what it's about. It's a real thing. And you can make some big mistakes in response to volatility. I'm just saying, what is your game plan to manage volatility? The conventional thinking has been bonds. I'm not so convinced. Let's get into the next segment.
well, we probably should at least touch on that today.
I don't know if we're going to get to all 5 then. Here we go.
Let's go.
Second segment.
We have 5 segments in this show, right?
Yeah, that's right. Or 6. Just kidding. We don't. It's normal show. There we go. How should your investment mix and your investment strategy change as you approach retirement and then as you get into retirement? Guys, this is one of the biggest mistakes that people make with their retirement plan. It ends up costing them a lot of worry, a lot of concern, and certainly a lot of money. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online. wisemoneyshow.com is where you can find us. Engage with us that way, or all over social media. Wherever you're at, we are there as well. Search the Wise Money Show. Your investment approach needs to shift as you get near retirement, as you enter retirement, and as you go through retirement. It needs to shift. It's different. A diversified buy and hold, maybe multi-strategy approach will be effective on the way up the mountain. You got to make sure you've got the right allocation, the right mix, you're taking the right level of risk, and that you have a good response during the inevitable volatility. But as you get to the top of the mountain, and as you start coming down, if you take that same approach, which is sort of option number one, just I'm going to leave everything the way that it is, odds are that as you see the first increase of volatility in the stock market, there will be a propensity to say, nope, I can't afford to retire if my investments are going to go down like this. I need to grab the wheel, make an overcorrecting adjustment, and go like very, very risk off. And I think that's the big danger. The advantage to it, though, of just, hey, I've got a diversified stock-heavy approach is 3 out of 4 years will probably work out fine. But like it could likely lead to overcorrecting.
Yeah, that's the risk. If you allow emotions, the swings, especially those in retirement, to drive a knee-jerk reaction, you can get yourself into some trouble. But part of the reason why that is a real risk and something that your emotions they're not necessarily lying to you, because we study retirement planning and investment management in retirement, and there's a phrase that we learn in the textbooks, sequence of return risk. And that is a nerdy term. But basically what it means is if you face really good times early on in retirement, and then later in retirement you have some really crummy years, you're going to have a very different outcome than if those years were reversed. And if you encountered really terrible times early on, and then it was smooth sailing from there on out, you might actually do enough damage in your portfolio that you have a hard time recovering, even with really good years that come later. And so the sequence of the returns, in other words, the order of good years and bad years, how they come to you, does matter. And it's unpredictable for the most part, right? Mm-hmm. But those first 2 to 3 years in retirement are the ones that are really, really crucial. It's harder to recover from a major bear market early on in retirement. And so risk management is it's one of the most crucial things that you and your certified financial planner can be talking about. And it's part of the reason why we don't just say, hey, blindly go into retirement with the exact same investment philosophy that you had that got you to the edge of retirement.
Yeah, actually, the fifth approach that we're gonna share with you later in the program addresses that very risk right there, that sequence of return risk. That's a real thing, and you can't really avoid it. How can you manage that risk? There's a solution here coming up. Let's get into...
I was just going to say, though, there are some times when maintaining the same investment mix as you go into retirement is okay. There are some people who get to retirement and they have enough guaranteed income or enough cash already kind of built up that you can go a number of years in retirement maintaining the same mix of investments, as long as, again, you are mentally prepared for the drop. You're not taking more risk than what your retirement forecast needs or that you can stomach. And it may be a time for you early on to not take your foot off the gas entirely, but maintain a similar mix if you've got that guaranteed income rolling in.
Yeah, yep, I agree. At the last break, we were talking about, so go there to the YouTube channel, check out the bonus content there. We're talking about one of the concerns with just a traditional stock bond mix and the disservice that it can deliver in your investment experience and keeping up with, your purchasing power and keeping up with inflation and so on. And I think that's one of the other risks or negatives with just, all right, well, I'm going to solve the getting down the mountain by just keeping a diversified mix of stocks and bonds, and maybe I just increase the amount of bonds and I'll be okay. That's the right way to do it. I had shared that's what I maybe would have believed 20 years ago, and it's not necessarily what I believe right now. Let's shift to the second investment approach. Speaking of 20 years ago, this was very popular. This was the way to invest for retirement a few decades ago. I don't know if it's making a comeback. I just like it. I like it better. I really do. And this is dividend investing. So what's that? I mean, it used to be the way people do it. What is it, Josh? How would you explain it?
Yeah, this is basically where you are selecting individual stocks or maybe mutual funds that are picking individual stocks that are pretty well-established, profitable companies that are in the habit of paying out those profits to the shareholders in the form of a dividend. Some people think of dividends the same as getting interest on a CD at the bank. It's the income that gets kicked off from your investments without you having to sell any of those investments. So just think of a dividend as profits, the portion of the profits that are being paid out from the company to the owners of the company. And so you just recognize that not every company has that habit. They don't have that type of a policy in place. Some are very much taking their profits and plowing it right back into the company, buying up competitors and expanding operations and everything, trying to grow the share price. Whereas other, maybe well-established companies, think the Coca-Colas or the McDonald's or a lot of utility companies or energy companies, they will pay out profits in the form of a dividend on an ongoing basis. And it allows you to just draw income off of your portfolio if you maintain a nice basket of these types of stocks.
Here's what I love about it. You're getting income from your investments. And if you structure your financial life where you just live on that income, you're not needing to sell your principal. You're not needing to sell the investments, sell the stocks. And in theory, they're growing as well. But here's the problem. Back in the 80s, I'm looking at it right now, the dividend yield of the S&P 500. Back in the 80s, it was between 4 and 5%. And if you go back even into the 50s and the 40s, yes, there were stretches. It never got below 3 during that time. Right now, at the time we're recording, it is 1.17%. That's the yield. And if that was the interest rate on your CD, you would say, I can't afford that. You can't afford to live on that. That's terrible interest rate. But that's what the dividend yield is right now, because we talked about it a couple of shows ago that it's becoming more popular for companies to keep their profits inside the company for future development, research and development, future exploration, maybe acquisitions, that sort of thing, or use those dollars to buy back shares of their own company instead of paying them out as dividends. So know that that's the risk, is that the yield that you're getting is so low that you'd likely, if you're gonna go this investing approach, you are gonna have to save up such a large portfolio so that this low dividend yield gives you the income that you need for your lifestyle.
It'd be interesting to do a study looking back. You said it was in the 80s that it was 4 to 5% dividend yield with the S&P 500.
Yep.
I wonder at what point was it that, stock compensation to executives became more and more popular?
70s.
In
Yeah,
the
70s,
70s?
but it really picked up, obviously, with the tech boom. And I mean, I'm looking right at the chart here, and really with the emergence of the internet and computers, that's when you saw this go straight downhill.
Where companies were getting, or the leaders of companies were being compensated by helping the stock price grow as opposed to just make them profitable and return dividends to the shareholders.
Yeah, I mean, there's two. So the first one we said was keep everything as it is. The second one is dividend investing or income investing. And really the question, the financial planning question that you need to answer is, which of these 5 strategies that we're going to go through can I afford?
Oh, yeah, right.
Because if I've got $5 million, then I might be able to just have an income portfolio, and I don't need continued growth to outpace the impacts of taxes and inflation, my two mortal enemies on the way to retirement and all throughout retirement.
But if you've got $1 million or $750,000, then the dividend yield is likely going to be such a small amount. It's not going to be enough to supplement your Social Security. You might need to explore different strategies. I like it. There are high dividend strategies, and we've got some as well. And so if this is appealing to you, work with your certified financial planner on that. We've got more coming up here on the Wise Money Show with Korhorn Financial Group. Okay, do we stay with the same question? What's one money rule? I've got another one. So one money rule that you used to believe in that you since changed your mind about?
I think I feel less rigid about people not having debt in retirement. Debt does represent risk, and there are certainly folks who get to retirement, they have some debt, and maybe they regret it or it holds them back in some way. But it can also be a tool that can help navigate, like when you draw off of retirement accounts, when you're cashing stuff in out of an IRA, that sort of thing.
Josh, the promoter, I just want to let you guys know we have a show coming up next week about that exact topic. You're in your 50s, you've got debt, you are also making that final push towards retirement. What do you prioritize? Thanks for leading us there, Josh.
Yeah, right.
That's
Well,
where we're going.
and this actually ties into what we're talking about, because we're talking about investments and your investment strategy in retirement. I know that's what the show is about, but if you said, what's the most important thing as I'm approaching retirement and throughout retirement, investments are a component of what's important. It's not the only thing that's important.
Yes.
Because I would put your balance sheet side by side with your investment portfolio.
Yep.
And if your balance sheet is correct going into retirement, then that actually takes a ton of pressure off your investment strategy.
Totally. Right. So Josh is wrong. Thank you, Kevin. You're right. What about
Glad to set you up.
what about envelope system? If my first answer was controversial today, do I feel the same way about cash? Just spending cash. I think I still feel the same way. I love it. It's the way to go. I just don't think you can functionally operate in this society just based on cash.
But that's not really what the envelope system
I
says.
know.
Like, you can't. You're right. You cannot run everything on cash. Some people have tried over the
I've
years.
tried to mail Amazon cash, and it doesn't work.
No, but having a few key categories where visibility of how much do I have to spend, it is still the most powerful way
The
to
principle, I
budget.
I completely agree
Especially
with.
for lifestyle things.
Yeah.
But it used to be, guys, it just did used to be easy. It was more of a scalpel or maybe a sledgehammer where you could just say, oh, you're having this cash flow issue? Nope, it's cash only. Like one way, like a life hack to get to that prioritization, like you mentioned, Josh, you used to be able to say, all right, other than the gas station, you have to adopt cash only. That's it. And now you just can't do it.
What do you mean the gas station?
Well, you can walk
Prepay.
into the gas station and
Some of
cash.
them, yeah, some of them.
you're starting
Okay,
to
this
sound
is
a
not a
little
show about
lazy
gas
here.
stations,
Yeah,
but
yeah.
I think the gas station would be the perfect example of how cash could still work. The problem is the gas station is designed to separate you from your cash.
Because everything in there is expensive.
You
and
walk in
convenient
and you see those hot dogs on the rollers.
Oh my goodness! Oh, one man's trash.
You just set my lunch plans.
All right, here we go. Third segment.
And those burritos on the roller.
Oh,
Those are dangerous because you really can't tell how long they've been there. The hot dogs, you got to sense when they're green. Don't touch them. But those burritos, they
Words
just
to
stay
live
that
by.
way.
Don't touch the green hot dogs.
All right, here we go. Third segment. What's the right way for you to invest during retirement and during those crucial years, especially at the beginning of retirement where sequence of return risk is so potent? Having the right investment strategy can really help you have a successful and confident retirement. We're helping evaluate the different choices right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. Yeah, we're reviewing 5 different investment strategies that you could implement during retirement, talking about pros and cons and which one's appropriate for you. You will. So the first one was just you leave everything the same. You have a diversified mix of stocks and bonds during your career. You just keep it the same in retirement. There's risks to that. The thing I like and we like is that you're still holding some stocks. A lot of people do shift and think, well, in retirement, I probably can't have any volatility because things are, I'm in the withdrawal mode, and therefore I shouldn't hold stocks. That thinking can lead into this third investment approach in retirement. And guys, I think this one it does help with those emotions, and it's often one that someone is talked into, coerced into, as opposed to they go seek it out. And that is income investing using very, very inflexible tools, income annuities.
Yeah, and so the A word is kind of a 4-letter word, depending on who you talk to. I think annuities. The way I look at annuities, I think we as a firm look at annuities. They're a tool. So we're kind of indifferent as to the tool itself. Now, the problem with annuities themselves is they have been overused. Mm-hmm. They are oversold. And if you look at 100% of the annuity product availability, we might look at about 15% of the entire universe of annuities and consider them. So I think, well, when should I have an annuity? If I am a saver, I've only ever been a saver, and volatility is, I cannot stomach it, an annuity can be a great tool. You can get some results with an annuity that might not be available someplace else for saving. Annuity is really powerful for tax deferral for some folks, especially savers that need tax deferral in retirement. Just a multi-year guaranteed annuity that behaviorally will behave very similar to a CD. It's not a CD, so don't hear me say that a fixed annuity is a CD. But if you observe their behavior, you'd say, well, they act the same. They have a time certain. They have a guaranteed rate of return. They have these various things. So the other time an annuity could be really helpful is if you know yourself and you say, hey, I don't have the discipline that it takes, and I need to exchange a chunk of money that's coming out of my retirement plan for a guaranteed stream of income, and then that's how I'm going to do my budget, that's how I'm going to structure my life, and that's how I'm going to do it.
Yeah, I mean, you're kind of describing almost the difference between having a pension at work versus having a 401k. If you have been saving into a 401k out of every paycheck, you know that as it performs well, you're happy and you're making progress towards your goals. When it declines in value, maybe you're disappointed in the short term, but also buying in at lower opportunities there. A pension is completely different. You don't know how it's performing. You don't see the ups and downs of the mix of investments that's being managed on your behalf. You simply know that there is a promise out there that when you retire, you'll be able to draw an income for the rest of your life. It's similar to the promise that the Social Security Administration has given to you. When you turn on that stream of income, you won't outlive it. And that has a lot of appeal. And an annuity is a type of an investment tool that can provide the same types of guarantees. And yeah, I just used the G word. We don't normally use the G word. Guarantees only apply to certain types of investments, but they're only as good as the company that is making the promises to you. In their, just in its most simple form, though, as you just said, Kevin, it's taking a lump of cash that you control and you're giving up the control to the annuity company in exchange for a promise that they will make income payments out to you for the rest of your life. And it does address one of the biggest risks that you get to retirement and you live longer than you ever imagined. You know, if there is a significant longevity in your family and there are just better odds that you're going to live, well into your 90s or even beyond, One risk is that you live so long that you draw down and deplete your assets before you're depleted, right?
Yep.
Well, an annuity is one way that you can start to address that type of an issue. So it does have a place. And as you said, Kevin, it's a tool.
Right.
You guys are way too nice. What's wrong with you today?
Well, so if we're talking
two of
about
my favorite people on the planet, so you are very, very nice. I figured, like, given the choice, where do you start with the attributes and the benefits of the A word, or do you start with the negatives? It's all been the benefits. And guys, the drawbacks are significant.
Well,
you lock this money up,
right.
and you give up all flexibility.
Yes.
And so, Kevin, you started with there's different flavors, there's different types of these types of tools, and specifically in retirement, the ones where you are exchanging a chunk of assets for a promised income stream, that can make sense for some dollars, in some unique situations. The challenge is a lot of people get talked into it for a large chunk, almost all of their money, and these financial individuals that recommend them to everyone. It's like, you have to have this, and you lose choice, you lose flexibility. And for the majority of people, it's not. I wouldn't make that trade.
And it's even worse than that, though, because when you buy into a contract or into an annuity contract, it is just that. It is a contract with an insurance company, essentially. And you have got to understand what is written into that contract, because as you point out, Mike, you're giving up a lot of control, a lot of rights, but there's flexibility for the company built in there. If you can't get out for some period of time without surrender penalties and things like that, but they can change some aspects of the deal after it's already been struck, like what interest are you receiving? How low can it go? What fees are they able to take it up to? A lot of that stuff can change after the fact, but you don't necessarily have the same flexibility yourself. So just know what is in that contract before you venture into one of these.
Yeah, if I were going to list out the cons of an annuity approach, I would start with, what am I buying? And most people are buying a product, and you don't need to buy a product. You need to buy a process. So you need to pay for a financial plan with a financial planner. The plan will determine which products satisfy the needs. The products themselves, the annuity products, like you're talking about, Josh, these contracts, they are incredibly complicated. And the insurance company can unilaterally make changes and you can't. And if you've ever sat down with a client and you've seen that all they have is annuities, they've got 5 different annuities, and they really like their guy, and he's sold it to them, but you look at the contract they bought in 2014, and the rate of return since 2014 is 1.5%. You're like, no, that means it's too expensive.
Yeah.
This annuity is not able to do for you what you need it to do.
Yep. I mean, but they are tools, and you've got to look at your financial situation and what your goals are to determine, well, what tools are the right ones for the job. It's just this one has been used for a lot of jobs that probably a better tool would have been more appropriate. So, all right, target date funds. That's the fourth investment strategy, and it's very similar to the first with a slight twist, and that is it's on autopilot. You don't need to make any adjustments. So you keep the same investment strategy, but it's automatically ratcheting down. Guys, this is one that I think the retirement plan industry, the 401k world and regulations, I think they are going to be pushing more and more people to use this as their retirement income strategy. Kevin, you're more connected with the retirement plan space and some of the rules. They're trying to adjust and make the 401k more of a retirement income tool as opposed to just an investment planning tool. So we're going to talk about the pros and cons of using target date funds, and then what's the fifth, our preferred suggestion for investment retirement strategies. We got that and more coming up on the Wise Money Show with Korhorn Financial Group. Oh, I wasn't going to give it to him.
I know, but I didn't know if
I was
he knew
ready.
that, so
Yeah.
Put me in, coach. I'm ready to go.
All right. Well, let's find a quick one here. Bonus content. What's biggest misunderstanding people have about Roth IRAs?
I think my favorite one that I ever heard was I was meeting with this great couple, and they are longtime family friends, and we just love them. But she thought she was too old to contribute to a Roth.
That's what I was going to say.
That was mine as well.
And this is, it is interesting to me, the misunderstandings that are possible, but we eat, sleep, and breathe this stuff, and so we understand it. So when someone has a different understanding, to me, it's always curious, like how could someone get there? Now, there are a lot of things I don't understand. I don't understand how cars work. I don't understand how, even how these microphones work and these headphones. And I don't understand a lot of stuff. So I'm sure you could follow me around and I could ask some very interesting questions throughout the day. But that one, to me, I thought, we've got work to do. If people think I could be too old to contribute to a Roth IRA, the living in the most financially literate community in the world, we've got some work to do.
Yeah, a lot of people know the age 59 and a half as the age when you can start drawing off of many different types of retirement accounts without a penalty, but they often interpret that as, well, that's also the limit on how old you can be. Or others just, hey, I am at age 65, I'm drawing Social Security, maybe I'm still working some, and they don't realize that, hey, you can still be contributing here.
Yeah.
But I mean, keep right on going. I mean, people think when my required minimum distributions used to be at 70.5, I have to take all my money out of my retirement plans. And so there are a lot of misconceptions, which is, I mean, that's one of the reasons why we started doing the show 10 years ago, was to help people understand.
11 and a half years ago.
Okay.
But who's counting?
15. I mean, who knows?
Wow. All right. Here we go. Fourth segment. Target date funds and then personal pension plan. So, and I would like to give the bulk of the time to that fifth strategy so we can teach it.
Okay. So do you want me to?
Well, yeah, I was trying to tee you up because it does feel like the retirement plan there are regulations that are trying to say, no, just keep this target date fund and it'll shift it to the target retirement income fund and you'll be fine. Yeah, gross. So, all right, here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the YouTube channel. Go to YouTube, search the Wise Money Show. What do I mean by a lot? Pushing 2,000 videos. It's a lot of content. It's our 11th season of the show. Every episode's on there, and we've got Next Wise Step videos that air all throughout the work week, as well as shorts, because people just want like really concentrated content delivered right to you. But it's all designed to help you take your next wise step in your financial life from a comprehensive financial planning perspective. Go to YouTube, search the Wise Money Show, subscribe to it there. Guys, we're talking about the 5 different investment strategies you could implement in retirement and pros and cons. And we're getting to the 5th one, which is the primary one that we use for folks, not because, this is, Kevin mentioned, we take a process in a process approach that creates a lot of flexibility, but also manages the cons from these other investment strategies is typically addressed with this 5th one. But before we get there, the 4th investment strategy that you could have in retirement is just throw it in a target date fund. Don't think about it. It'll auto-adjust, auto-correct for you. I have significant concerns with this. Kevin, what are your thoughts?
Well, again, it's a tool. So, Mike, you just a little bit ago said target date funds, and then you said IC or something like that, and that's fine. They don't have to be your favorite, but I do think if we're just calling balls and strikes here. So if you said what are the pros and what are the cons, one of the one of the pros is target date funds are a great way to get started. So if you're just starting in a 401k and you say, hey, listen, I don't understand any of this, I want it really super simple, then I would say, well, just get started in a target date fund. And if you're in your 20s, go out to a 2065 target date fund. These things have dates that they have a target. But you need to understand the difference between a to target date fund and a through target date fund. And in retirement plans, it's not uniform, it's not standard. So you might be in a retirement plan that has to, and you might be in a retirement plan that has through, and likely you don't know the difference and it's never been explained to you. And so when you think of two retirement plans, the idea is we're going to get you to the door and you take it from there. So for instance, if I had a 2030 retirement date fund and today it was 90% stocks, by 2030 it'd be in 40% stocks. Mm-hmm. So it is adjusting as we go versus a through retirement fund. Think in terms of a glide path, but it continues to gradually de-risk as you go. So this is where, if you're going to stick with it, it's not our preference, because once you have enough resources, when I think of a target date fund, the easiest analogy is it's an automatic.
Mm-hmm.
Yeah.
And so do you need an automatic or a manual transmission? And I personally,
I hate that analogy, Kevin.
Because you don't know how to have a manual.
I used to. But I know
it's like driving a stick or riding a bike. How's that? Is that better?
Okay. So, but here's what I don't like about it. And there's two. Okay. One is it feeds right into the right percentage of stocks and bonds will be what you need in retirement. And I think that is oversimplifying, and I think that potentially could be missing it completely.
Sure.
So just as you get to retirement, just own more bonds and you'll be safe. I don't agree with that. I think you need multiple strategies to fight inflation as well as manage volatility.
Yep. Like
that. And I wish we could just loop that. But the second thing that I really dislike about target date funds is if you understand the concept of target date funds, then likely you've also heard the concept. This is completely different, but it's on the same level of the benefits of dollar cost averaging. That as you are investing every single paycheck and climbing the mountain, you are able to buy more shares when volatility spikes and share prices go down. Your $500 investment or your $1,000 investment or whatever, you're buying more shares when the prices are low, and that's a benefit to you. If you just hold a target date fund in retirement, then you're selling some of that target date fund. You're selling some of those stocks every single month to give you the income that you need so that you can make your withdrawals. And that means the exact opposite. You have to sell more shares when those prices drop. So this year in March or April during the tariff tantrum, very, very volatile time. If you needed your income in April, you would have sold a lot of your target date fund, and you would have sold a lot of stocks at very low prices for you to get the income that you need. I just dislike it. There is a better way.
Yeah,
and better way.
That better way involves you partnering with your certified financial planner, looking at your retirement game plan and being opportunistic, paying attention to what is the market throwing at you and deciding where are the good exit points to maybe take some gains off of the portfolio, to exit out of certain key investments, and basically harvest cash that you can live off of.
So that leads us right into the fifth investment strategy, which we call the fifth investment strategy to implement in retirement. And this one solves a lot of the cons and addresses many of the pros from the previous four. We call it the personal pension plan because this is an investment approach that pension companies use to both assure people that they can get their income today, but also ensure that people will be able to get their income 10, 20 years from now when they need it. It's also been termed buckets of money. Josh, can you explain the personal pension plan? How does it work? What are the mechanics?
Yeah, I like you referring to that as a bucket of money type of an approach. But basically, we say we want to break an overall portfolio down into 3 different segments, and they each have 3 different goals in mind or purposes. The first one I like to think of as a paycheck simulator. It's 2 to 3 years worth of cash that you have set aside in safe investments that are not going to fluctuate in value. And this is where, think of it like the faucet that's going to turn on the income to pay out to you on a regular basis. It's simulating or replacing the paycheck that you were used to. And it's enough cash, as I said, to cover the first 2 to 3 years worth of spending. The reason that's so important is because of something we referred to earlier in the show about how those first few years of retirement, if you experienced a major decline in the markets or in your portfolio and you had to start selling investments at depressed prices, as you were just explaining, Mike, you're going to have to sell a lot more shares when the market is down just to harvest the same amount of cash that you were hoping to be able to live off of each month, as opposed to when the markets are strong or your investments are up. This takes that off the table. It says the first 2 to 3 years or the next 2 to 3 years at all times, we want to have that cash on hand. The second segment then is an income generator. This is where you're using tools like maybe bond ladders or CD ladders or fixed annuities, investments that have some guarantees or some planned outcomes to it. Like, you know what it's going to be able to achieve for you over the coming 7 to 8 years, let's say, on top of the 2 to 3 that you already have. So now we've strung together a timeline of 10 years of relative certainty, right? High confidence that you know your income is taken care of for that decade. And what does that leave? It leaves the rest of your portfolio, the money that by definition you don't need for the next 10 years, leaving it in a growth-oriented portfolio that is still more aggressive than what maybe you might naturally want to choose. But we're quick to remind clients all the time that those are the dollars you're not going to touch for a long time, a decade. That means you have the ability to let it grow, let it bounce around in value and compound for you even into retirement. Those are dollars that you'll be able to harvest out of and replenish the income generator and the paycheck simulator then.
So that addresses some of the concepts we've mentioned earlier, where the sequence of return risk, like Josh mentioned, nope, you've always got a chunk in low volatility, low risk types of investments, or high. We know what the parameters are for how this investment's going to perform. Also, it keeps a large chunk invested for the long term, fighting inflation. It gives you great flexibility as that long-term bucket during times when it overperforms, you can use those dollars to replenish some of the earlier buckets. And if it's underperforming, like when I talked about my father earlier, hey, nope, it's okay, settle down. We don't need those dollars. We're not going to touch them for another 10 years. We can be patient, let them respond. So work with your certified financial planner on that. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.